Welcome to the Coin Bureau Weekly News Roundup. My name is Guy, Jessica is out on assignment, and here are the top stories in crypto this week. Slow but steady. Crypto prices creep higher as large individual and institutional investors buy in, and insiders and bag holders sell out. What's next for the market? Itching for Ethereum. Investors await an overdue rotation into ETH while DeFi degens pile into another problematic layer 2. When will ETH finally follow BTC to yearly highs? Binance case closed. The world's largest crypto exchange settles with US regulators, paving the way for a spot Bitcoin ETF approval. Everything you need to know. Banks in trouble. Barclays and Citibank announce layoffs, the Fed's BTFP facility continues to grow, and UBS makes peculiar comments about a bailout. How this could be bullish for crypto. And of course, a closer look at last week's top performing cryptos and where they could be headed next. All this and more in just a moment. Last week, the crypto market continued to creep higher, with BTC hitting its highest price in over a year and a half. BTC's stability has served as rocket fuel for altcoins, and many rallied by double digits. Be sure to stick around until the end to hear which altcoins were the biggest gainers. Anyways, in retrospect, this mostly sideways price action was somewhat expected. That's simply because the correlation between crypto and stocks has been at its lowest level in years. The result is that it's been crypto factors that have been moving prices, not macro factors as was previously the case. And of course, the number one crypto factor that everyone's been focused on is the approval of a spot Bitcoin ETF, which could happen as soon as January next year. This is when the next window for approval opens. For context, the most recent window for approval closed a little over a week ago. As such, it's not surprising that the crypto market has been trading mostly sideways. What is surprising is just how much investors are looking at other crypto factors through the lens of a spot Bitcoin ETF. The elephant in the room here is the historic Binance settlement, which we'll come back to later. Now, assuming the crypto market doesn't get wrecked by an unforeseen crypto factor or a meteoric macro factor like another pandemic, then it's safe to assume that this week will be the same as last. That means BTC moving gradually higher as speculative money spills into ever smaller altcoins. Lo and behold, this is more or less what the BTC charts suggest. On the daily, BTC continues to trade within the same channel it's been in since the start of the month. On the weekly, BTC is painting doji candlesticks, which suggest a neutral trend. Meanwhile, on the monthly, BTC is about to close a third month in the green. This could be bearish given that 3 green candles in a row tends to result in a correction during the fourth month. However, if we're at the beginning of a new crypto bull market, then there could be many more months of green ahead. Now, if you have no idea what I've just been talking about, be sure to check out our recent video about candlestick trading. It will explain it all. And while you're at it, check out the Coin Bureau deals page to take advantage of the massive trading fee discounts and bonuses of up to $40,000. It's only for a limited time, so don't hang about. The link will be in the description. Anyhow, all the spot Bitcoin ETF hype has made it easy to forget that Ethereum has some pending spot ETF applications of its own. And it's become even easier to forget given that ETH's price action has paled in comparison to most altcoins, notably Solana, which we'll be doing an update on later this week. So make sure you're subscribed to the channel and you've pinged that notification bell so you don't miss it. Now, if you watched our recent video about how to trade crypto, you'll know that money tends to flow from BTC into ETH. Although these flows initially appear to have skipped ETH, the charts suggest that ETH could finally catch up to BTC. That could mean a rally of 20% or more. As you can see, ETH appears to be painting a pattern that we like to call the topless P, which is analogous to a bull flag. This admittedly bizarre pattern is extremely common in crypto, and in this case it foreshadows ETH hitting as high as $2,600 in the coming weeks, depending on how you measure it. This possibility is reinforced by the ETH BTC chart, which essentially measures ETH's strength against BTC. In this case, ETH appears to be painting a W pattern, which is analogous to a double bottom. Interestingly enough, many altcoins have recently seen this bottoming pattern in fiat terms. What this pattern suggests is that ETH is about to rally hard against BTC, but there's one caveat. There appears to be a few tail risks lingering for the second largest crypto. If you watched our video about the Binance settlement, which we will come to in a moment, I promise, you'll know that the DOJ seems to be targeting DeFi. Obviously, most of the total value locked in DeFi exists on Ethereum, including most of the stablecoins in circulation, which are also facing regulatory scrutiny, but that's a topic for another time. As you might have heard, there have been quite a few high-profile DeFi exploits in recent weeks, namely KyberSwap. These exploits have not only raised the eyebrows of regulators, but they've appeared to cause the crypto community to become more cautious as well. This is certainly the case when it comes to Blast, an upcoming Layer 2 on Ethereum that we recently covered in our newsletter. The link to that is in the description too. If you're already subscribed to our newsletter, then you'll know that the total value locked on Blast has been growing fast. This is despite the fact that it's not currently possible to withdraw your crypto, only to deposit. And yet, by the time you see this video, it's likely that it will hold more than 600 million in TVL. What's scary is that most of this TVL is made up of ETH being staked through Lido Finance, aka STETH. STETH is the most popular form of collateral in DeFi, and it trades mainly on DEXs. What this means is that any exploit of Blast could not only do damage to STETH, but the entire DeFi ecosystem on Ethereum as well. Now, the funny thing about this kind of FUD is that it has somehow failed to play out over the last few months. Take Binance, for example. In theory, any crackdown on Binance would result in a massive crypto market crash. Even US authorities were concerned about this happening over the summer. In practice, however, Binance CEO Changpeng Zhao, or CZ, has proven that it's possible to de-risk the world's largest crypto exchange without anyone losing a single sat. CZ, who had to step down as part of the settlement, is being hailed as a hero by many in the crypto community, and with good reason. Tree of Alpha put it best, quote, "Quick moment to say CZ handled the shutdown of his $23 billion stablecoin with zero funds lost, negotiated a multi-billion-dollar settlement with government agencies, and I can still trade and withdraw from there with no issues through all that." For reference, in case you need it, Binance and CZ reached a multi-billion-dollar settlement with US authorities last week. This officially ended an investigation into the exchange which had begun way back in 2018 and had escalated significantly over the last year. The CFTC and SEC both sued Binance. Besides paying a $4.3 billion fine, Binance will be monitored by the DOJ and the Treasury Department for the next 3 years and 5 years, respectively. Logically, this means that any bad actors in the crypto industry that have used Binance in the past are likely to be caught in the coming months. As for CZ, he must pay a $150 million fine and could face up to 10 years in prison. Later today, a judge will decide whether he is allowed to roam free until his sentencing in February. It's possible that CZ's detention, or lack thereof, could affect the crypto market, particularly BNB. Now, believe it or not, but this settlement is extremely bullish. That's simply because US authorities will presumably have enough oversight of Binance for the SEC to feel comfortable approving a spot Bitcoin ETF. Or rather, enough oversight so that the SEC doesn't have any excuse to reject pending applications. The caveat in this case could be Tether's USDT. The SEC has cited market manipulation concerns with USDT as one of the reasons for rejecting previous spot Bitcoin ETF applications. But it's possible that Tether is squaring things up with authorities as well. This possibility, which we pointed out in our recent video, is now making the rounds on crypto Twitter, where people are pointing out the parallels between CZ resigning from Binance and Tether CEO Jean-Louis van der Velde resigning 1 month ago. Some believe that Tether has likewise been de-risked. If this is indeed the case, then it's possible that the spot Bitcoin ETF approval could come even sooner than expected. After all, Bloomberg ETF analysts Eric Balchunas and James Seyfarth have both stated that an approval could theoretically come before January. It's just very unlikely to happen, apparently. And if you happen to be wondering how Tether's USDT has been affecting the crypto market, you can check out our video about stablecoin market caps using the link in the description. This brings us to this week's macro factor, which is the apparent banking crisis that nobody has been paying attention to. And this isn't our fault. It appears that the mainstream media has been doing its darndest to keep this news off the front page, lest it cause the fiat sheep to try and bust out of the pen. For those who don't know, there was a banking crisis back in March. And that's because banks are required to hold the safest assets on their balance sheets, that being government debt. Well, lo and behold, these safe assets become the riskiest when interest rates start to rise, and interest rates have been rising fast. The result is that the world's biggest banks have hundreds of billions of dollars of unrealized losses. In plain English, they're bankrupt, but only if they sell these assets. So long as nobody rushes to withdraw their money, these banks don't have to sell, so they can stay solvent until those losses go away. There's just one problem, and that's that banks' profit margins are simultaneously getting squeezed. You see, banks make money by borrowing money short-term and lending it out long-term. Under normal economic conditions, short-term interest rates are lower than long-term interest rates. The result is that banks earn the difference in interest rates between this debt, often referred to as the spread. The practical effect of the rate hikes from central banks is that they increase short-term interest rates above long-term rates, meaning that banks basically lose money on any new loans. As a result, banks lend less money, and this inevitably causes damage to the economy. That's because most of the economy is debt-driven. If banks stop issuing loans because it's not profitable to do so, then economic activity starts to slow. This process is reportedly starting to play out around the world. And these actual and unrealized losses have only continued to increase. This is probably why banks around the world have been aggressively cutting their headcounts. The one that's been in the headlines a lot is Citigroup, which began firing unspecified numbers of employees last week. The thing is that it's not just Citigroup or even just US banks. Back in Britain, Barclays Bank is planning on laying off thousands of employees to balance the books. And this news comes shortly after multiple UK banks experienced massive crashes in their stocks, notably Metro Bank, which fell by 30% back in October. Back across the pond in the US of A, meanwhile, banks have been leveraging the Fed's Bank Term Funding Program facility, or BTFP, to keep a banking crisis at bay. To refresh your memory, the BTFP makes it possible for banks to borrow against their assets as if they were trading at their full value. As you can see, the BTFP spiked back in March when it was introduced and continued to increase over the summer. It seemed to have flattened out in October, but has been spiking again in November. This tells us that banks are facing significant stress and borrowing money to make ends meet. The practical effect of this is that the money supply is growing. As pointed out by BitMEX co-founder Arthur Hayes, the Treasury Department has also been spending the money in its bank account at the Fed. This has further increased the money supply, and it could be contributing to the recent crypto rally. But there is another caveat here, and that's the Fed's overnight reverse repo facility, or RRP. Now, you can think of the RRP as being a mountain of money that exists outside of the financial system. Since the debt ceiling was raised, the Treasury has effectively been using this cash pile to refill its bank account at the Fed. As you can see, the RRP has been falling fast. Many macro analysts believe that when it runs out, the Treasury will be forced to pull money out of the markets instead, and that could cause most assets to crash. It's estimated that the RRP will run out sometime early next year. So, mark your calendars. Now, with all that said, it's about time we looked at last week's top-performing cryptos, which were Blur, Steppen, ApeCoin, Clayton, and Mina Protocol. So, starting with Blur, its Blur token appears to have pumped because it was listed on Binance. It's also possible that Blur is pumping because of the Blast Layer 2 we talked about before. Both crypto projects were co-founded by Tishun Roker, who goes by the nickname Pac-Man. The Blur token hasn't been around for too long, so its price action is a bit tricky to analyse. From what we can tell, though, it appears to face lots of resistance around these levels, but it's possible that the hype around Blast could keep the rally going, assuming BTC holds up, of course. Next up, we have Steppen, whose GMT token appears to have pumped because of an NFT contest that was held by the innovative Move to Earn crypto project. Like many altcoins, GMT has seen an explosive rally off the lows, but faces a lot of resistance on the way up, specifically around 40 cents. The good news is that the weekly chart suggests GMT is squeezing to the upside, which could foreshadow more gains in the coming weeks, even with a pullback. As for ApeCoin, meanwhile, it's not entirely clear what caused its Ape token to rally. We suspect it has something to do with the recent rally in the Bored Ape Yacht Club NFT collection. Whatever the case, it wasn't too strong of a catalyst because Ape hasn't pumped that much from a technical perspective. It's squeezing a bit on the daily, but struggling to get above the Bollinger Band on the weekly. Given that it's still a bit below resistance, it could squeeze higher in the coming days. Now, when it comes to Clayton, its Claycoin appears to be rallying because of a dApp built on its blockchain called Superwalk, which appears to be analogous to Steppen. Clay is a perfect example of the altcoin recovery that I was talking about earlier. As you can see, Clay bottomed at around 10 cents back in September and has been rallying ever since. The recent squeeze to the upside could be enough to push Clay above that key resistance level of 33 cents. And finally, we have Mina Protocol, whose Mina coin appears to have pumped on the news that the crypto project's developers are testing the blockchain to see where it can be optimized. Similarly to Clay, Mina appears to have bottomed in October and is up by 2x since that time. It's squeezing slightly to the upside on the weekly against a strong zone of resistance. If these altcoins can all get above these zones, we could be in for a full-blown altcoin season. And if you want to know when these alts are pumping and where to trade them, check out the Coin Bureau Telegram channel. The link to that will be in the description. Okay, that is all for today's Coin Bureau Weekly Crypto Review. So if you enjoyed it, you know what to do. Hit that like button, subscribe button, and bell icon as well. Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel. Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all. You can find the link to that resource and many others in the description below. So, thank you all for watching, and I'll see you all in next week's episode.